Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are modeling out the impact of the coronavirus as we look to getting back to work. Phil, it's great to have you with us as always. We're going to take a look at some indicators and trends that suggest the equity market in the U.S. at least is starting to normalize. And we can see that on our first slide here.
Yeah, there's a lot going on in this slide, but it tells a pretty interesting story. So you can see the dates in March in the middle had pretty close to record volumes in the US equity markets. We traded 19 or 18 billion quite a few times. And the bars is the extremity of the market move on that day. So a really bar is close to 10% down move, which you remember we had a couple of. And a really green bar is close to 10% positive. And in the middle of March stands out for being big swings up and down with really strong volumes. That compares to the average from last year of about 7 billion shares a day. So we were trading a lot more than average in March. And that started to come down, as you can see, as we got into the end of March and now into April. The volumes are sort of trending down towards 10 billion shares a day. And the color of the bars is kind of getting closer to gray. With, I guess, a bias towards the slight green, which we've been drifting upwards in the market.
All right, if we take a look at our next chart here, there's an interesting trend that deserves a little bit of investigation, and that's lit market share.
Yeah, I mean, just to continue on from the thoughts of the last chart, you can see the two lines in this chart as well show the volatility. So you've got realized volatility, which is the volatility the market actually experienced in blue. And it peaked at 150 right in the middle of March there, and it's come back down into the 30s. You've got the market's expectation of 1 month forward volatility, which peaked around 80, and it's also back down in the 30s. So in that period when the market was really quite stressed, early March into the middle of March, you can see the yellow blobs actually got up to nearly 70% of market share being on exchange. That's actually changed quite significantly. It's gone back to normal, and the last few days it's actually a bit below. So that's interesting. It could be retail trading a lot of stocks. It could be institutions in dark pools. We don't know yet, but there will be data available on that shortly, and it'll be interesting to see why the market dynamic has changed so much just in the space of a month.
Well, if you were to isolate oil and the financial sector, it tells a very different story than what we're seeing in the overall market.
Yeah, and it's not really consistent, is it? I mean, the oil prices just keep falling, which makes you think the market in the oil space is pricing in a more prolonged slowdown, I guess a slower pickup in activity next month and the month after. And there's a real fear when you look at some of the data that the on and storage facilities will be full in 3 or 4 weeks. There's stories already about people renting oil tankers and the cost of that doubling in the last week or so, because that's another place you can put oil temporarily. But the market for energy is really kind of bearish. And actually, when we start to look at the earnings season, a lot of the comments aren't that bullish. So although the equity market is performing like people's expectations have completely turned around, a lot of the banks have actually announced pretty big provisioning for credit losses. And there's a fair bit of fear among some of the smaller companies that they might not have the cash, or they might not be able to survive a prolonged recovery phase.
All right, and speaking of cash, if we take a look at our next couple of slides here, the dash for cash for companies in hoarding mode, it appears.
Yeah, I mean, just a sensible thing to do, I guess, especially before everything got too bad. But it's interesting to see how much cash companies manage to bank just to make sure they have enough to get through the crisis. Obviously, a lot of companies have announced that they're cutting dividends just to make sure that they can keep some of that cash in their bank account. The data today shows that's added up to around about $70 billion. But also, the corporate bond market has actually remained open for people doing new loans, and that's added up to around about 300 billion when you add in the revolvers, which are through banks as well. So there's probably a fair bit of liquidity that the companies have got, which is good, because there's a much higher chance that a lot of companies will be able to get through this, come out the other side, rehire the people that have been furloughed, and get going again, provided that's what happens.
All right, and like we like to do, ending on a good note, global new COVID cases are clearly in a decline.
Yeah, it's probably the first day where you look at the global chart and you see enough of a trend in that recent data to say we've peaked on global cases, and it does look like the world cases are falling. A lot of the countries in Europe and even in Asia are well and truly going down the curve in terms of new cases. Even countries like Singapore, where there was discussion about a second wave, have got that second wave under control. So it seems like we're learning a lot about COVID. We're learning how to get back to work. We're learning how to control it, which is very positive for the future.
We just have to make sure that we continue to keep doing it. Phil, as always, thanks so much for joining us.
Thanks, Jill.
All right, and thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.